Okay, class, you remember last time we talked about the balance sheet and how it came into being, and we talked about the merchants of Venice. And let's take a look at this example here. We have assets on the left side. Let's say this is a Venetian merchant of the Middle Ages. Cash, merchandise, property, assets totaling $10,000. Liabilities on the right side, some trade payables to his suppliers, bank loans, total liabilities $2,000. And remember, net worth is defined as the difference between assets and liabilities. When we say net, remember we're combining them together. If this merchant had to pay off his debts, he'd have to take $2,000 of his assets to pay his debts off. So his net worth, net combined worth, $8,000. And remember, when we add the liabilities plus net worth, we get the same balance on either side, which is why we call it a balance sheet. And you can see that because of the way we define net worth, the balance sheet will always balance. Now, as a matter of fact, if you walk into a bank today and ask for a personal loan, they'll ask you to fill out a form that looks very similar to this, listing your assets over here, your liabilities over here, and calculating your personal net worth. Now, for businesses, we use exactly the same format, but instead of net worth, we use the word equity. But exactly the same meaning, equity, being assets minus the liability, the balancing factor that forces the balance sheet to balance. You may have heard people talking about home equity loans or how much home equity someone has. For example, if someone has a home worth $100,000 and a mortgage loan of $80,000, then their home equity is $20,000. The home of $100,000 is the asset. The mortgage loan of $80,000 is the liability. Their equity is $20,000. Now, let's take a look at the logic of this balance sheet, and let's convert it to an algebraic equation. Very simple. Assets equals liability plus equity. That's called the accounting equation, and that is the basis upon which our entire accounting system is built logically, piece by piece by piece. So this is our starting point right here. Assets equals liability plus equity. You can remember that by visualizing the balance sheet, just like that. Now, let's go back to the story about the Venetian merchant. And let's see how different transactions affect the different elements of the balance sheet or the different elements of the accounting equation. Let's take this example. Let's say that this merchant has a colleague who needs his help. He asked him, will you please introduce me to the Caliph of Cairo so that I can begin my trade mission there? And so you, the Venetian merchant, say, that's fine. If you pay me $1,000 in cash, I will take you down and introduce you personally to the Caliph. So you receive $1,000 for providing your service. How does that affect your assets? Well, your cash is going to go up by $1,000. Does this affect your liabilities in any way? No, it doesn't. You still owe the same amounts to the same people. Therefore, how does it affect equity? Well, if the assets go up and the liabilities remain the same, the equity must, by definition, go up as well. So here we have the case where assets go up by $1,000, equity goes up by $1,000. Now, when we bring cash in because we have rendered services or sold goods, we call that revenues. So that when your equity goes up because you've earned money, we call that revenues. Let's take another case. Let's say you, the merchant, need to get a shipment safely down to Yemen through very dangerous territory, so you pay the Bedouin $500 to escort your trade mission safely down there. So you pay them the $500 and they provide the service. How does this affect your assets? Well, your cash is going to go down, so your assets will go down by $500. Any effect on liabilities? No. You still owe the same amounts to your suppliers and your bankers. Therefore, what would be the effect on equity? Equity, by definition, would have to go down as well. Now, when the equity goes down because we've incurred costs of doing business, we call that expenses. Let's take another example. Let's say you, the Venetian merchant, want to pay off this bank loan. So you take $1,000 of your cash and you pay off the bank loan. How does that affect assets? Assets are going to go down 1,000. Does it affect liabilities? Yes, now your liabilities will also go down by 1,000. How about equity? Is equity affected in any way? No, not at all. If assets go down and liabilities by the same amount, the difference between the two remain the same. In fact, let's take the complete opposite of the transaction. Let's say you, the merchant, need to borrow an additional 1,000. The bank hands you the 1,000, your cash goes up by 1,000. What happens to your liabilities? Well, your liabilities are also going to go up by 1,000, and similarly, your equity will not be affected in any way. Let's take one more example. Let's say you, the Venetian merchant, have this great strategy to expand deeply into Central Asia, but you don't have enough funds to cover it, so you go to your uncle, and you say to your uncle, "Uncle, I've got this successful business. I've got 8,000 of equity, but I need another 8,000. And the uncle agrees. He will contribute 8,000 of his own money into your business in exchange for an agreement whereby you and he agree to share profits. In effect, to form a kind of partnership. So from the business point of view, what happens to assets? Cash is going to go up by 8,000 when the uncle contributes his cash into the coffers of the business. Liabilities affected? No, not in any way. You still owe these amounts to these parties. So how about equity? Equity, by definition, must go up by 8,000. And we call this kind of a change in equity contributed capital. So you can see that for all the transactions of the business, we can analyze them by how they affect the various of these three components. And you will also notice that every transaction affects at least two different areas in equal and offsetting manners. And that will lead us into a future lecture where we talk about double entry accounting. But that's all I want to say now. Just remember the accounting equation, and every transaction affects at least two different parts of this equation in equal and offsetting manners. See you next time.